go to the income statement immediately. Yeah. What about the fact that's also the 20 difference? Why is it not 19 but 20? Yeah, because the transaction cost is now in the income statement, so it is going to go to the income statement, and the last profit on the disposal will also go to the income statement.
So what will happen to that 19 million eventually?
With this 19 million, what you put to the other comprehensive income. Okay, let's try to play it out. At the end of the year, where are you putting OCI? OCI will be taken to the separate line of the equity. What is the name of the separate line in the equity? There is a name to these guys. Not retained earnings. It's going to be revaluation difference on, previously we called it available for sale financial instruments, so we called it available for sale reserve. Now we are going to call it how? Well, I don't know, but I keep seeing, one of my favorite clients is a bank, is a small bank. They can never do the books properly, but they come up with just enormous names. How they call it currently is revaluation reserves of FVOCI assets. And I was like, what is FVOCI asset? And that's fair value to OCI assets. So we have a separate line for that in the equity. Okay? And basically what we had previously as available for sale, instruments, reserve. They just renamed it. Okay? Hold on. Now what are we going to do with this? Since the asset is gone, I cannot keep it there. I'm just going to dump it to retained earnings, but will not touch the income statement. Big no-no. Because previously I recycled it back, and it went to the retained earnings from the PN.
So it's available for distribution,
depending on your country's rule. Because distribution is always a legal issue and not an accounting issue. Okay? As a lawyer, believe me, I've been to lots of trials trying to protect the laws. Okay? Now, good. So what you need to know is that this one change brought about by IFRS 9 as recycling of gains and losses previously in other comprehensive income is not anymore permitted. Okay? Be ready for this. There is another example, however, guys, I don't really have the time to go over it, so you will read it later. Now, so I have the two categories basically, the amortized cost and the fair value, right, as measurement basis. Amortized cost is only if criteria met. Fair value is basically always. Now guys, the only difference is where do you put the difference, right? So to OCI or to income statement. Now, let's go and let's see what is this criteria. Here is the criteria. If the business model is to hold the instrument to collect contractual cash flows, okay? And the contractual terms of the financial asset give rise on a specific date to a cash flow that are solely payments of principal and interest. Okay, let's start with the first one. The first one is the so-called business model. How do I need to do the business model? On the entity level, aggregate level. How do I need to do the other one? The contractual cash flow level at instrument level. Everybody who has financial assets now getting ready immediately to do the documentation regarding that. You need to have a documentation, a business model documentation, and the cash flow characteristic documentation. I tell you what my banks are doing to my auditing. Whenever they make a new product, immediately, usually they call us that we have the product description, we fax it to you, and then you tell us if it is amortized cost or fair value through P&L, and then usually we tell them that you are in misunderstanding. We are the auditors. You do it and then we will check. Yeah, but at the end of the day, of course they will say that, what do you want to check if you are always in disagreement with us? Tell us what to do, right? No, you have to listen. All right. Now, we are going to talk about this in a minute, but I would like to talk about the so-called fair value option. You remember the fair value option that I can put everything into the fair value, and previous standard, IAS 39, there were no real, there were no real rules. When can I put something into the fair value through P&L? Here, there is a very strict rule, which is going to tell us that we only allowed to use the fair value through P&L if it is actually eliminates or significantly uses an inconsistency. So accounting mismatch. So if to keep it under amortized cost would be misleading. Okay? Now that's the new one, guys. I promised you that that's the new one. That's the new one. Okay? So this one you haven't seen. Even if you have been here last year, I told you something different because this just changed. Okay. So, only financial assets with contractual cash flows that are solely payments of principals and interest would qualify for fair value through OCI. What am I talking about? The debt instruments. You remember what was debt instrument? Business model, contractual cash flow model, or other way around, doesn't matter. We have to meet both criteria, right? And then, the rule is that I may use the amortized cost, and I may choose to opt into fair value. Okay? Now hold on for a second. Only if the accounting mismatch thing is true. However, in the bit in between, I will have the fair value through OCI. Now when can I use that? If both of my objectives are true, I want to collect contractual cash flows, but I keep selling and buying these assets. Can you tell me an example on that? It's very hard. So all the way during the flight from Budapest to Doha, I was thinking about the situation when I met with this. And I can only came up with one. I tell you what was that one example. I know that in 5 years' time, I have to buy a major asset, but a major one. I have to basically build a new airport. Okay? You're kind of good at that. By the way, you made such a big airport that it's impossible to change the planes. Right? So even though that it looks nice, it's very frustrating if you miss the plane. The old airport was little and crowded, and you could not get through security. Only if you transfer the planes, it took 1.5 hours, right? Monday morning. But at least you could catch the plane, right? Now it's impossible. Anyhow, you know what is very funny? The only flight from Budapest to the Middle East is, well, until October, it's only the Qatar Airways, right? So everybody is coming here, so the plane is always that full, right? And you never have the big planes, you only have the little planes, right? But it's very funny that every one of my colleagues were used to the little airport, so they were like walking like this when the terminal changed. And Qatar Airways allows connecting time, which is 45 minutes. All right? Which means that everybody was walking casually in the big airport, and then we started to realize that, look, we have to go to C77, and this is only C2. Only have 20 more minutes, don't worry. And then after walking another 10 minutes, and it's C4 now, then we started to run, right? Everybody who is traveling to that part of the world at least missed one flight. And you know what's the really fun part? We have one flight, one a day. So what are they saying after we missed it? Oh, sorry, Mr. Lapatis, you need to change your plane. I said, okay, I know I missed it. But it's your fault. So you need to pay for the new ticket. But it was, I mean, you sold me the ticket that I can connect. Yeah, but you need to hurry up. So at the end of the day, they charge you for the ticket. Actually, they didn't. And afterwards, they actually told me, you know what was the next saying? Tomorrow we don't have place on the plane. So what are you trying to tell me? You need to stay in Doha. I'm like, I can't, right? So anyhow. So all the way, so you need to buy a new airplane. This is where we started at. So in order to save up for it, I kind of collect these debt instruments, and I keep my money in those. Why don't I buy shares? I don't want to risk it, right? I keep it in debt instruments. Hold on, I'm not done yet. in the debt instruments, sometimes I see that there are better options. I know I want the money from it, but I keep changing them. Why? Because it's going to be in 5, 6 years when I have to spend, and there are going to be better options later. Now that's a fair value through OCI, debt instrument. When the portfolio is actually used in order to have the cash. But since it's usually in a time which is in the distant future, I keep managing it actively. Got it? And in this case, you can use the fair value through OCI, but only like this. That instrument. Okay. Characteristic of the asset test. So it's all, what is the characteristic of the asset? It's only principal and interest. If it fails, it goes to fair value through P&L. Test. Business model test. And look. Hold to collect contractual cash flows. Then it can be amortized cost. Fair value option is elected. Then it will go to fair value through P&L. Can I use the fair value option here as I want? No. Only if it is accounting mismatch. Hold on. No. Not freely. Only if I can show that both to hold the contractual cash flow and B, to sell the financial asset. If this is true, then that is going to be the fair value to OCI. So I'm keeping the, it's not a residual category. So I have to show both. Okay? I had several questions from my clients that when is it okay to use it? Honestly, I don't know. All right? Because at the end of the day, it is not going to lead to fluctuation in the net profit, but it will allow you to calculate your equity at a reasonable level. But that's the only reason I can come up with. So most probably if you know that you want to keep it, then amortized cost model is a better idea, in my understanding. However, this option is available. If none of them are met, then it's going to be fair value through P&L. Okay? Now, how to assess the business model? Just very quickly. It must be on the entity level, and you need to see what is your objective. I have a few examples over here, what you might want to read at home. I really can't go over each and every one of them, except of the first one, okay? Just very quickly, because I want to finish today the expected credit loss, because that's the fun part. Let's see this example. Entity holds instruments to collect contractual cash flows, but would sell the investment in particular circumstances. An instrument no longer meets entity A's investment policy. For instance, you are required as a pension fund to keep only, I don't know, BBB plus or something, and it falls below, and you sell it, okay? Or the entity is an issuer and adjusts its portfolio to reflect a change in expected duration. You know what I'm saying? So you don't want your liabilities be 10 years and your assets be 3 years, right? Because then there is a mismatch between the two sides of the balance sheet in terms of the duration. Then you adjust, okay? Entity A needs fund capital expenditure. Now, is it going to be meeting the business model or not? Is it a business model to collect contractual cash flows? Sometimes you sell. Yes, but it's still going to, so basically it is actually only your financing needs are going to be taken. So we still say that your objective is to hold the instrument and collect the contractual cash flows. So if you make sales, it won't contradict, right? Given that the reasons can be explained and are logical. Okay? As opposed to this. As opposed to 3. Please go to 3. Not the second one. The second one is not a good example. Second one is actually a contradictory example.
I told you, can I buy them back?
Yes, you can buy them back, that's fine. That's not going to be contradicting either. I mean, if you are temporarily selling them, right? This is what you are asking. That's fine. That's still going to meet the characteristics. Okay? Now, let's see the next one. Entity D actively manages a portfolio of financial assets in order to realize fair value changes arising from the change in the credit spread and yield curves. Entity D's objective results in active buying and selling. So you kind of buy loans with what you are going to do what? Actively buy and sell in order to make a gain because you are betting on the yield curve. Is it going to meet the the business model test? No. So this one is going to be a fair value through P&L. Why? Because you actively buy and sell. Okay. So this was the business model. Now, please go over here. The contractual cash flow characteristic test. Yeah, you are going very slow, so I need to skip some slides. Now, read this very quickly. Only principal and interest. Anything which is more than that shall not be classified as amortized cost. Let me give you an example on that. You know what is a reverse float? When the interest rate is working against the market. Is it interest and principal? No, because that's not a real interest. Or I'll give you another one. Interest linked to gold price. What about that? That is also going to be something but is not just interest and principal because there is an embedded derivative basically in it. What? The gold. So only these types are going to be allowed. So the not genuine or the de minimis. What is the de minimis? It means that the effect of the other thing that is included is not having really an effect. Okay? Now good. Yes, and some examples I made. Characteristic of the financial asset test. Some instrument that will qualify. Look, a bond with a stated maturity date. Principal and interest are linked to an inflation index that is not leveraged. Okay, hold on for a second. Inflation index. Inflation is okay. Inflation is okay. Which means that if it is linked to the economy itself, we are accepting it. Let's see another one. Variable interest rate loan with stated maturity date that permits the borrower to change the period of market interest rate at each interest reset date on an ongoing basis. So when it's changing and you need to change it, but it's again a typical contract, then it's fine. Let's see what is, for instance, not going to qualify. A constant maturity bond with 5-year terms that pay a variable rate that is reset periodically, but always reflects a 5-year maturity. Because this is, again, basically something what is almost like an embedded derivative. Or, let's see another one. This is actually the most typical one that I have. A convertible bond that is convertible into the equity instrument of the issuer. Why? Because there is an option to convert. Right? So there is something embedded to it. Okay. Now, go to the unquoted equity instruments for a second. How do you value all your equity instruments? Either fair value through P&L or fair value through OCI. But what is common in that two sentences? Fair value. So at the end of the day, you need to calculate your fair value no matter what. Okay. Previously, if we were unable to calculate the fair value, what did we use instead of it? Cost. Please remember, the cost option is eliminated in IFRS 9. So cost may not be used no matter what you are doing. So you have to have a fair valuation for that. They don't give you proper guidance how to do it. However, it is the rule that cost option is not there anymore for the unquoted instruments.
Can we
Although,
use the net book value?
well, what we are trying to do in this case, we are actually trying to prove that the book value is the same with the fair value. Who you need to convince? Auditor, and you need to convince them that this is a proper level 3 measurement. You know what is a level 3 measurement? What is? Not observable. Actually, the game is mainly on this. All right. Last thing. Before the break, because you guys do need a break. Reclassification. Easy. Not allowed. Okay? Unless the business model changes. But it's going to be very rare. Okay? Now, I want you to actually stand up a bit and put blood over here. And we are going to come back for another 45 minutes and going to do the expected credit loss. All right? But stand up a bit. All right? But don't go away from the area. So we have to capture you. Right? They are going to be next. Right? Go and stand up for a few minutes and we are going to come back. Yes, basically. Because if you choose amortized, but if it's amortized cost, you are not allowed to do that. If it's amortized cost, you are not allowed to do that. You just can do the amortized cost, which is going to the P&L.